this is not about Bitcoin. It's not about Ethereum. It's about a complete and total business model revolution. So it's not just financial, it's everything. And once people open their minds to it, you'll see how big this is. It's coming. I mean, I'm working on this actively in the background in various projects. It's coming at you much faster than you understand. You know, if we you know, you see me with that adoption curve chart all the time, just trying to get people don't really yet understand what that means, right? We're 300 million active users worldwide in digital assets. It means it gets to, essentially, it's growing at 185%. We get to 600 million plus, call it 750 million by the end of this year. Even if we have a slow year, we get to 500 million. The year after, it's 1 billion. The year after that, it's 2 billion. The year after that, it's 4 billion, right? So the speed of which this is coming, people do not comprehend. And the movement, I think, from the $2 trillion asset class today to the $200 trillion asset class that Jeff's talking about is by the end of the decade. It's the fastest growth of any asset class in all history, the fastest adoption of technology in all history, and it's going to be the fastest generation of wealth in all history. That's what's going on. And we all get lost in the day-to-day of the ups and downs of the market and, you know, shouting at each other over Cardano versus, you know, fucking whatever. And it's just all noise. It's just noise, because you've got the biggest, fastest secular trend any of us will ever live through. And we can participate. We don't have to be VCs. We don't have to be the rich dude who's got the access. You just need to get involved. Yes and no, but it changes at the margin, right? If you to go back 2 years and look at the narrative, then a year ago, then now, then to Goldman Sachs's homepage being about digital assets, you know, the world is waking up. As Jeff said, is a lot of the journalists are behind and they're forced to write stories because crypto is engaging. And so they come at it with not enough knowledge yet. But, you know, over time, I'm seeing more and more people getting a little more comfortable with the space. But journalists have this habit of always wanting to find a balance to a story, so that they use the FUD, even though most of it is completely wrong, as their balance, as opposed to writing something more nuanced. And I think that's the issue. But over time, at the margin, it's changing. I mean, the reason I got into Bitcoin originally back in 2012-13 was Cyprus. It was exactly the same. They took the entire savings out of the banks and said it's ours now. And I realized that we didn't own anything. So yeah, I mean, and you know, what happened after Cyprus obviously was a huge run in crypto for the same reasons. I think you're dead right. And also I think there's the other thing at the same time that's come, which was the shift from using crypto and digital assets to this soft term of Web3. It's much easier for regulators to say, of course we should upgrade to Web3. If we're on Web 2 now and Web3 is better, we should do it. It doesn't have the word currency in it, which was the big toxic word. And so I think that creates a decent Trojan horse as well, to make it easier for people, the regulators or the politicians particularly, to say, yes, you know, we need to be pioneers in Web3, as opposed to we need to be building cryptocurrencies. So I think those two things, the narrative, which is, as you said, the core case of why these digital assets really matter, plus this new kind of fancy dressing for it all, I think this is a very significant moment. Meanwhile, when you go to Wall Street, they're adopting it really fast now. You know, having spent a lot of time in that world and still speaking to a lot of people, whether it's the giant asset management firms, whether it's the giant pension schemes or the investment banks themselves. So basically, you know, those guys don't make a move without the regulators giving them the nod saying it's fine.
Of course, yeah.
It's just tactics. It's tactics in a situation where technology is going so fast that they don't know how to keep up with it. Because, I mean, they still haven't ruled on bloody Ripple. What are they going to do with all of the DAOs, all of the NFTs, the social tokens? You know, they're so far behind that they're going to have to draw the line somewhere. Because what are they going to do? Just keep fining everybody, give them a slap on the wrist and letting them move forward? And this goes on in perpetuity? I get it. It's a tax. So they're going to do that a bit. You know, if you go back and think where narratives come from, they don't come from nowhere. So where did the narrative about energy use come from? Because obviously it's ludicrous. I think if everybody put on their kettle at the same time, we'd use more energy around the world than crypto mining, right? So Bitcoin mining. It actually came, I believe, from the ECB or within the European institutions because they wanted to slow adoption. And they've got an ESG mandate. So if they knew it would bump up against that ESG mandate, they could slow adoption. And they're not trying to slow adoption necessarily to stop it, but just to buy them time to figure stuff out because they're feeling like they're out of control of a situation that's moving too fast. So that's what they're doing. And now sanctions is another way, is, you know, they're going to use this for bad gains. What they're trying to do is like, please stop adopting it. Brand is undervalued as an intangible on the balance sheet. So what you're going to do is turn brand, and brand is community and network, into a tangible. So what the hell are all of these companies going to be worth? I saw some report that's like $43 trillion in the S&P 500 in intangibles. And all of this comes tangible. I mean, it's a complete revolution. And what I think the key concept they get out of it is if you're a 12-year-old today, you are unlikely to need to work for a company or go to college because you can actually participate in these cultural communities of which you are both a network participant and a network kind of motivator and activator, and you get tokens. And therefore, you create universal basic equity. You're taking an equity stake in the cultural communities that you're part of, be that Disney, be it the favorite music artist, be it gaming. That is an incredible difference. So you're doing community work for income or assets. And that solves a lot of the problems that technology is creating, where technology, AI, robotics, eating the world. Well, we create something different, and I kind of like it. It also creates a very different community. If you're on Twitter, it's a toxic cesspool of people insulting you all day and a bunch of really nice people trying to learn from each other, and it's really difficult. But when in a token world, what happens is if you want your community to thrive and your token to therefore maintain value or increase in value, you're going to only encourage certain types of behavior. And generally good behavior is going to be rewarded by the community. So you're going to change the nature, because we all are overwhelmed by social media and what it means to us. But when you go to an environment where it's driven by the token, it changes. You see that in Discord channels. People aren't mean to each other. They're just enthusiastic because they're all incentivized by the same thing. So there's a huge change coming here that's going to solve a lot of problems. Don't lose sight of, if you take the adoption chart, when I always talk about living in the future, what does that mean? What does it mean to have 3 or 4 billion people in 6 years' time? Well, it means a complete change in everything we're doing. And that's not Bitcoin and Ethereum accruing all the value. That is what Jeff's talking about. That's social tokens, community tokens, NFTs, and that's putting up all of the other assets on chain as well. So it's a lot. There's a lot about to happen.